Bloomberg Audio Studios.
Podcasts, radio, news.
The chairman of the Federal Reserve, Jerome Powell, wrapping up the June Fed decision. No change at the Federal Reserve to interest rates. Plenty of changes in the forecast. Inflation moving up a little bit. The dot plot moving down a little bit. Equity markets just about holding on to gains and still near all-time highs on the S&P 500. On the Nasdaq, we're still higher by 1.8%. The Russell up by 2.2. If you turn the page and switch at the board and get to the bond market, this is where things start to get interesting. Yields were down by double digits at the front end throughout most of the morning and into the afternoon. We're now down by only 9 on a 2-year at 474.55. And if you take an intraday chart of the 2-year yield, this shows the story of the morning and the afternoon perfectly. I want to show you 3 moves. The first move was 8:30 Eastern time this morning when CPI came out cooler than expected. What you see on yields, drop. Easy to see. On the far right side of the chart, 2 moves I want to point out. One's at 2 p.m. Another is in the news conference. At 2 p.m., we had some forecasts. The dot plot came out, and we all wanted to know where the median dot would be. In March, it signalled, or at least implied, 3 cuts for 2024. That came down to 1. Yields started to climb. And then we all had a big question going into the news conference. Well, hang on a minute. Did they factor in the inflation report that came out this morning? And obviously, inevitably, Chairman Powell was asked about it. This is what he had to say.
What's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think we'll see PPI tomorrow. We'll know more about the PCE reading as the month goes on. But the initial CPI reading and its kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes.
And it didn't look like many people made any changes, Lisa. And for that reason, that's why you see that spike higher, that little move higher again on a 2-year yield. Cue the confusion around the forecast.
Well, is this by design in some levels? Basically, there were a number of Fed officials who got that CPI print and opted not to change their inflation forecast. Did they do so because they want more than 3 inflation reads to really gain confidence in some sort of disinflationary trend? Is it because, all things being equal, it's better to send a hawkish signal to markets that are eagerly looking for any opening to buy into any idea of a rate cut? All we know is that was a slight disappointment that's being reflected in slightly higher yields that have taken back about 5 basis points from earlier this morning.
There's always going to be a big conversation about where the median dot is. But when these numbers came out, you were the first to point this out. The split amongst the policymakers elsewhere. TK, just to go through this again, for those of you just joining us, this is what we saw. Get away from the median. On the committee right now, the dot plot shows 4 policymakers who saw no cuts this year. Some anticipated just 1 reduction. That was 7, and 8 expected, Tom, 2 cuts. The Federal Reserve is kind of all over the place.
Yeah, they're bifurcated. And what's important here is the dispersion is not smooth. It's like basically 2 camps. I thought Luke Kawa, of all people, had a wonderful tweet out on this, really pointing out the polarity that we see in the Fed as we stagger through the summer.
I want to pick up on the labour market and talk a little bit about that. So on Friday, payrolls came in and it looked really hot. On the headline number, 272. But there's 2 surveys that go into payrolls. There's the establishment survey, payrolls. There's the household survey. That's the unemployment rate. Unemployment came up to about 4%. We all wanted to know, what weight would Chairman Powell put on the headline figure and how much weight would he put on the household survey? And he kind of said something like this. Sometimes it's difficult to reconcile the differences. Payrolls might be a little bit overstated. Makes more sense to look at things over the last 6 months or so, Lisa. Overall, the picture is strong and we've got a gradually cooling labour market.
People really honed in on the idea that the payroll jobs growth may be overstated. That line caught a lot of people's attention at a time where he reflected the confusion that we all felt, which is the reason why some people said, we don't believe these numbers, we'll wait for the revisions. Nonetheless, this is why he's talking about a series of data points, and maybe is part of the reason why they aren't having much conviction, because this is just sheer confusion that we're feeling from the Fed.
Do you remember when Diane Swonk used to talk about aspirational forecasts of the Federal Reserve? Let's have a look at unemployment together. 4% on Friday. This is where they see it year end. Median projection, 4% year end 24, 4.2% year end 25. Lisa, year end 2026, 4.1%. Now, I understand the Federal Reserve has a great influence on things. They can shape the events they anticipate. If they start to signal that unemployment is going to 5%, we've got a problem. And I think you see the market freak out. But to signal, based on your own projections, that we finish basically flat from where we are on unemployment by year end and climb to 4.2 by 2025, is that aspirational or realistic?
You know, we said a lot of their projections were aspirational a year or 2 years ago, and yet they were correct. So I'm humbled to sit here and say that they're just purely aspirational when we have not seen the unemployment rate climb to such a significant degree. And they've actually had to decrease their expectation for unemployment rates just simply because the labor market was stronger than they expected. Now, I would argue that the idea of upgrading their expectation for inflation and keeping the same number of cuts, just pushing them back to a later time, raises some questions. And this was asked at the press conference. How do they accept that, given that they don't see the labor market breaking and that they want to get back down to 2%? How do we thread that needle? And that's a good question that I didn't really hear an answer to.
Mike McKee's run out of the news conference and got in front of the camera for us. Mike, let's catch up with you. Chairman Powell, did he manage to square the circle in that news conference?
Not really. John, I was thinking during this of the line from the old movie Blazing Saddles where the preacher says, "You're on your own, boys," because there doesn't seem to be any kind of direction here from the Fed about which way they're going to go and when. They're still their base case, as I mentioned in my question to the chairman, is that they're going to cut rates this year, but they don't see any difference at the end of the year between the economy now and the economy then. So how are investors supposed to anticipate what the Fed's going to do if the Fed doesn't know and can't give you any guideposts? The chairman said, well, we need a couple more reports that show things improving. But what is improvement? Last month, we saw the CPI change by about 1/10 of a point and the PCE changed by about 1/10 of a point. And Chris Waller said, well, that's not good enough. I give those reports a C+. So it's really hard to tell what's going to move them. Obviously, he's sort of signaling not July, but from September on, it's an open question.
Mike, they want the convenience of a dramatic ex post decision. Maybe that's not the way the script goes this time. What will you watch in the data that allows them to get out front as they've never done before? Well, maybe the 90s, but basically that they've never done before.
Well, basically, you want to see what they want to see, an improvement in inflation data, but how much is going to be the tricky part. We'll have to watch both what the market reaction is and what the data show, and then what they say in their speeches. At the same time, we will also be looking at the unemployment rate and job creation to make sure things don't go south there. Either one might push them one direction or another. I think that at this point, they're going to be as cautious as possible, but they do seem determined to get at least one cut in.
Mike, a lot of people were asking, including both Mohammed and Bob Michael, whether the Fed officials really understood the CPI data and kept their projections. We got kind of an answer, but Seema Shah put it this way. If they did know that, maybe that implies that they need more than 3 months of softer inflation prints before they can be convinced to cut rates. Do we have any clear message from the idea that, yes, Fed officials had the information and, yes, they had the chance to change their forecasts, and no, they did not do it?
Well, the chairman suggested that some people may have changed their forecast, but the majority didn't. It's not going to be extending the number of inflation data that they get. It's going to be more of the same that we saw today. It doesn't have to be maybe the same magnitude, but it has to be a continued sequence of slowing inflation for them to gain confidence. That's their magic word, is confidence, and they don't tell us what would give them confidence, but it seems like several more, one or two more maybe, would give them the confidence that they could start moving towards cutting rates.
Mike, you're an expert at the data, far more than I am. If you look at domestic final sales, take out the noise of trade, the world's agony, et cetera. If you look at domestic final sales, what's the run rate on the economy that they're going to be dealing with to July 31, September 18th, and near the election, November 7th?
Well, we were still in that area, Tom, 2.8% in the first quarter. Still well above trend growth for that. And the Atlanta Fed GDP now is running above 3%. If you take that one and you take the first quarter GDP and average them, you're at 2.2% for the first half. So they're going to be dealing with, and they predict they're going to be dealing with, an economy that doesn't slow down at this point and doesn't affect the labor market at this point. And the interesting thing is they see core PCE inflation going up, but they're still talking about raising rates, or cutting rates rather. So it's a situation that kind of leaves everybody at sea here as to what it is they're actually going to do. If they wanted to advertise, listen to our speeches. This is a good advertisement for that.
Yeah, Mike, I'm not sure if that one bites. Let's see if that works. Mike McKee, thank you, sir. Great work, as always, in the news conference once again. This is the calendar for the next month or so. So July 5th, you get another jobs report. Let's see if it looked like the one we got on Friday. July 11th, you get a CPI report. Back end of July, very last day of the month, July 31, another Federal Reserve decision. No questions really about July, Lisa, but I guess it was implied based on the forecast we got a little bit earlier.
Basically, it seems like July is squarely off the table. It was not even a consideration. September, though, Jay Powell didn't even entertain that idea. He kind of hemmed and hawed. I don't want to talk about time frames. We don't want to be like, squared in,
I'm
given
sure
the fact
Powell
that we
would
want
love
to be
this
flexible.
impression of him.
Well, I
He's
mean,
tuning in.
honestly, that was exactly what he needed to do, right? Wasn't that kind of the goal that Bob Michael set out for him, was to do nothing? I mean, if anything, he had the most hawkish message relative to market expectations in a long time. So it was somewhat of a different Jay Powell than we've gotten in the past. But, he wouldn't really solidify anything. And that, I think, was by design, given their confusion.
I think emphasis really matters in news conferences, of course. It matters. It's pretty straightforward. It's where he didn't put the emphasis. He didn't really put much emphasis on the forecast for economic growth, unemployment or inflation. Where he actually put emphasis was on the destination for the Fed dots. And I thought it was pretty interesting. So we were all sort of geared up to focus on 2024. Would the dot plot, the median dot, come down from 3 to 2, maybe to 1? It comes down to 1. But then you're looking out to 2025 and they give you 1 back. So they take 2 away and then throw an extra 1 in 2025. So really today, when you look at the dot plot, the ultimate destination, what's changed for the FOMC just in terms of the path for rates from here?
Basically, that just the disinflationary trend is happening more slowly than they previously thought, but that at some point they will have this same trajectory just on a delayed time frame. And that was essentially what Jay Powell laid out today. And maybe on the margins, that's a bit more hawkish than the 2-year was pricing in before.
I'm going to go to modest further progress. Modest is on the y-axis. I have no idea what it means. Further in progress, John, is exactly what you were talking about, which is what they're doing here is they're extending out the optionality of their timeline, their x-axis. Because to your point, Lisa, this disinflation, it is slower. David Rosenberg, not the next Rosenberg. David Rosenberg says eureka, but what they did today was extend out the x-axis with further progress. That's not in any textbooks. That's marketing baloney as far as I'm concerned.
We can get to Jeff Rosenberg right now at BlackRock. Jeff, wonderful to catch up with you, sir. Let's get into it. What did you make of these forecasts, and can you square the circle for us?
I agree with Lisa. It's a little bit hard to square the circle here from the press conference. I mean, obviously, the morning's data set the tone for a very dovish press conference, and the 1 hike median kind of took the wind out of the sails, and so Powell was kind of faced with that as the backdrop, and so it was maybe a little bit less of the dovish Powell than we've seen in the past. But I think he did give us a couple of insights. One, he did talk about the overstatement argument on payrolls, a little bit to last week's data. Two, he talked about 2.6, 2.7 as being, I can't remember exactly the quote, a fine place to be. And I think that does reveal that this is a Fed that doesn't have to get to 2% anytime soon. And that's part of this asymmetric response function. If inflation is a little bit too hot, then we'll just hold pat. And if there's weakening in the labor markets or any kind of unexpected weakening, then we're going to cut, and we'll cut more aggressively. And so I think they're comfortable with this path of inflation. And then I think on the third point, there's just a bit of confusion about how stale are the SEP forecasts relative to the new information from the morning. I think what is clear here is that having been a little bit burned by the enthusiasm at the end of last year and then the reversal on inflation, they're not going to want to reverse so quickly with just one good print. And he stated again and again, they'll need more than just one. And I think that's why you had maybe the hesitancy. But understand that the difference between 2-cut and 1-cut median is 1 member. This is a very fine point to be seeing, pretty big shifts in market pricing. I think the broader theme here is this is still a Fed that is looking to cut rates Very supportive to financial markets. Obviously, the data this morning is supportive to that. A little bit dismissive about the strength of the labor market. So I think this is a pretty good setup here for bonds and stocks.
Does this mean, in your view, that September is still very much on the table, even if Fed Chair Powell really demurred when it came to a time frame?
I do think it is, and I think obviously, this is the volatility that is what happens when the data lights the way, when you're completely abandoning forecast-based policy for data dependence. But if we do get in the interim period between now and September, reports that are along the lines, we don't have to get as big of a downside surprise as inflation as we've seen, but that continued gradual rebalancing of the labor market, stabilization to slowing on the inflation side, then I think absolutely September is in play, as well as December and the two cuts that are not in the median, but I think are still very much in play here.
Jeff, when he stepped off the stage, we were up 2.8 standard deviations on both SPX and NASDAQ 100. We've pulled back a little bit from there, selling into the excitement tomorrow morning, I guess. Jeff Rosenberg, simple. How do you invest in this? Do you just clip a coupon? Do you increase your cash level in this uncertainty? Is there an opportunity?
Well, I think, as I mentioned, the opportunity here is that this is a Fed that is very asymmetric, and they're asymmetric with regards to holding policy flat in the face of disappointing data in terms of strength or policy progress on inflation, and then very supportive on unexpected weakening in the labor market. I think that's very supportive to financial market conditions. I think there's a longer run problem with that potentially, but in the short run, this is a little bit more favorable to risk markets and to risk taking. You can step out of cash into that front end of the curve. This is a Fed that's telling you that they're going to cut rates. So cash has been very supportive because they've held rates up, but the path going forward, and Jonathan mentioned it, this is just shifting the cuts into 2025. So you're going to lose the income by hanging out in cash. The belly of the curve for fixed income investors, the front belly of the curve, 2 to 5 year part. I think that's a very attractive part of the curve. I do think you have to start moving out into that part of the curve to lock in those rates. And the economy, to the comments on Mike McKee, GDP Now, the forecasting, above trend growth relative to the fears of recession. This is a very supportive market environment for credit. That's a carry argument. I think you can clip coupon there, take some risk there because the default risk is still very much low because the growth side of the economy is very strong.
Jeff, stay close. I'll get you back in just a moment. I want to talk about 25 by talking about 24. There's 4 meetings left this year. July 31, September 18, November 7th, December 18th. I want to go to the November meeting. November 5th, there's an election. The day after, they kick off a Fed meeting. Michael McKee, we're all talking about forecasts for 2025. None of us have got a clue, have we, about what 2025 is going to look like?
Well, you take a look at the dot plot for 2025 and compared to 2024, it's very, very spread out. There is no consensus at all. We pick a median for convenience and talk about it, and we say, okay, they're putting us up for 4 rate cuts next year. But really what the dot plot is telling you is they have no idea. And one of the reasons is we could have a completely different fiscal policy next year. And we have a lot of issues, including debt ceiling, the government funding, and the tax cuts that are going to expire that could change the economic picture tremendously. So I'm not going to tell Jeff Rosenberg how to trade that, but I don't think you can have a whole lot of confidence that what they're predicting today is going to be anything like what we'll be seeing at the November meeting.
And Mike McKee, thank you, sir. Of course, the forecasts are always more instructive to really gauge the reaction function. That's what's important here, how they respond to incoming information. But let's just run with this. The forecast for 2025. Bramo, what are they worth, given how much could change in November onwards?
Well, this is the reason why Bob Michael said, I'm in charge here. I'm a bond market investor, and I'm the person who sets the rates right now, not the Federal Reserve at a time where they are just as confused as ever before. I am curious, Jeff, what is your take on that? That right now we see big bond investors saying we're setting rates. The Fed is a bunch of confused people who are looking at the same data and equally confused as everybody else. We can look at supply and demand. We can react to all of the economic data. Sure, yields jump up and down, but we're the ones that are kind of the main guy in the room.
I'm going to agree with Bob Michael very much so, especially when we're talking about the back end maturities and the term premium. This is a Fed that's going to get less into the business of setting term premium and influencing the maturity of rates and the difference between demand and supply, particularly as Mike McKee was just mentioning, we're going to have a big issue around fiscal deficits and their financing, and much more of that is going to be borne by us, the bond market investors, the private sector. So a lot more of that term premium, and then resetting that term premium is going to be dictated by financial markets. It's partly why I think the front end of the curve is a bit more attractive, because the term premium, you're going into that uncertainty with relatively low, yes, we're off the historical lows, but relatively low compensation for both term and inflation premium. I think that makes the back end a lot more challenging. And because we view it as more challenging, there's less demand. You're going to have more supply. I think that could be a factor towards a little bit longer run process of steepening out both term and inflation premium in the back end.
Jeff, what's important here, and you said it, that there's a risk-on feel to this, and certainly we've seen it in technology, and SPX before he ended his press conference up well over 2.8 standard deviations. Is the answer here, Jeff, that everything is just plain solid? There isn't the polarity of a boom economy or doom and gloom. It's just a solid American economy?
It's pretty solid, Tom. I mean, when you look at that domestic demand component, and it's so solid that, last Friday when I was on, we talked about the question that was asked a bit today, how restrictive is policy really? You're not really seeing it in the economic slowdown that you'd otherwise expect outside of the interest rate sensitive sector. So for risky assets and for credit, as I just mentioned, I think that's a good thing. So I do think that the strength of the economy here helps to underwrite some risk taking in a broad sense. And there's a bit of a worry there that may be leading to maybe less progress on inflation. But I think what we heard from the chairman today, they don't need, yes, they're going to say we want to maintain policy and get back to 2%, but it could be a long period of willingness to accept 2.5% to 3% as good enough. Take the win. We've come from 7 down to below 3. That's a good outcome, and not risk the economic growth side by over tightening.
Jeff, love doing this with you. Thank you, sir. Jeff Rosenberg there of BlackRock, wrapping up Fed decision day and CPI morning as well. Let's get some final words around the table. TK, first to you. Final thoughts.
It's going to be eventful through the rest of the year. I thought it was off of CPI this morning, just spectacular. Yes, they're data dependent, but you know what? It's going to be eventful right up to Jackson Hole and beyond.
Anyone who is looking for some sort of certainty in the bond market, some sort of stability, good luck. Because right now you have a green light to go crazy, to see bonkers types of moves, to quote one of our guests earlier this week. Because right now there is no central planning when it comes to where rates are going. And that to me is significant at a time where at one point that was considered a financial stability risk. Right now, it doesn't seem to be. I don't know if that's a sign of strength or fragility, but right now, that is the takeaway. These double-digit moves in yield on a daily basis, they seem to be here to stay.
Well, right now, we're giving some of that up.
Correct.
I'll just recap some of the price action. Session highs on the S&P 500. About 20 minutes ago, we were higher by more than 1.3%, now positive by about 0.7% on the S&P. In the bond market, at the lows on a 2-year yield, we were down 16 basis points. We're now down about 7 or 8. So some of this unwinding just a little bit. The team's going to take over from here. They'll run you through the close. They'll catch up with former Fed Governor Betsy Duke and Jim Chanos. Look out for those conversations. From New York City, that's it for us. We'll see you at the end of July. We're all away until then. From New York, this was the Fed Decides.